Have you ever wondered what happens when trust in our most foundational financial institutions, like our banks, just completely fails? It's a question that rattled the whole globe a little over a decade ago. And the answer to that question didn't actually come in the form of some new government policy. Instead, it arrived as lines of computer code.
Welcome to the Explainer. Today, we're laying the groundwork with What is Cryptocurrency? Module 1. Whether you're entirely new to the world of digital finance or you're just looking to solidify your foundation, you can consider this the essential first step of your crypto journey. We're going to break down the complexities, look directly at the data, and build up your understanding right from the ground up.
Here's our roadmap for today. We're covering 4 main parts: the birth of crypto, crypto and blockchain explained, key benefits and realities, and finally, Bitcoin versus altcoins. Let's get right into it.
Starting off with part 1, the birth of crypto, from crisis to code.
So, to really understand why cryptocurrency even exists, we actually have to rewind back to the shock of 2008. The traditional financial system experienced this massive earthquake with the failure of large investment banks in the US, which set off a brutal global financial crisis. What that did was expose a huge vulnerability in the history of money, the single points of failure in centralized banking. Fast forward just 1 year to 2019, and in direct response to that crisis, a pseudonymous individual, or maybe a group of people, going by the name Satoshi Nakamoto creates Bitcoin. The fundamental goal here was just to completely eliminate the need for those central middlemen altogether. And look at where we are now in 2024. US regulators have actually approved spot Bitcoin ETFs. That signals an incredible evolution from what was once just a fringe internet rebellion to a heavily regulated multi-trillion-dollar global market.
That brings us to part 2, crypto and blockchain explained, the digital ledger.
At its core, what exactly is cryptocurrency? Basically, it's a digital or virtual currency that is secured by cryptography, and it exists on a completely decentralized network with zero third-party intermediaries. The absolutely crucial point here is that its primary superpower is operating entirely outside the direct control of central banks or governments. You aren't relying on a bank to verify your balance anymore. The cryptographic algorithms and the network itself do all the heavy lifting to ensure the digital money cannot be counterfeited or double spent.
But how does it actually achieve that without a bank involved? Well, through a blockchain. You can think of a blockchain as a distributed digital ledger. Imagine a massive public record book, but it's shared simultaneously across thousands and thousands of computers globally. We call those computers nodes. Every single time a page is filled up with verified transactions, it becomes a block. And that block is permanently connected or chained to the previous one. Because this whole ledger is distributed across the entire network, there is literally no single central server for a hacker to attack. It is secure by design.
So let's look at what this looks like in practice. Step 1, you request a transaction. Let's say you're sending some crypto to a friend using your secure private key. Step 2, the network of computer nodes immediately steps in to verify this transaction using complex cryptography just to ensure you actually have the funds you're trying to send. Step 3, once it's validated, your transaction gets grouped into a block and permanently added to the ledger. It's this incredibly simple, elegant 1, 2, 3 sequence that is fully transparent and virtually impossible to forge, all without a middleman taking a cut.
Moving right along to part 3, key benefits and realities, the trade-offs. Because honestly, with any revolutionary tech, we really need to look at both sides of the coin.
Let's start with the advantages, which are absolutely profound. By operating on a decentralized network, crypto entirely removes those single points of failure. If one node goes down, it doesn't matter. The network survives without a hitch. It eliminates third-party intermediaries, meaning you have true autonomy over your assets. It also heavily streamlines cross-border remittances. You can convert fiat currency to crypto, send it across the globe in a matter of seconds or minutes, and convert it back, completely bypassing the massive delays and hefty fees of traditional banking. Plus, the ledger is transparent and immutable, meaning the financial history is pretty much tamper-proof. But that total autonomy comes with some stark realities. Because there's no central authority, the pseudonymity of these transactions can unfortunately allow for criminal use, like money laundering or ransomware. There's also an ongoing environmental concern. Mining popular cryptos takes incredibly high energy consumption. Sometimes a single transaction can use as much power as a household uses in a whole day. Then there is the extreme price volatility. Bitcoin famously surged to nearly $65,000 in late 2021, plummeted to just over $20,000, and then roared right past $73,000 by early 2024. Talk about a roller coaster. Finally, you have programming risks. Bugs in smart contracts or hacks on off-chain exchanges can literally lead to a total loss of your funds.
And speaking of losing funds, 11% to 18%. According to analysts at the crypto wallet company Ledger, this is the estimated percentage of all Bitcoins that are permanently, irreversibly lost. Why? User error. Remember, decentralization means you are your own bank. If you lose your private key or forget your password, there is no customer service number to call to reset your account. You cannot reverse a transaction once it's sent. The autonomy is absolute, for sure, but so is the responsibility.
Which leads us perfectly to our final module, Part 4, Bitcoin versus altcoins, the crypto ecosystem.
While thousands and thousands of cryptocurrencies exist out there, two really dominate the conversation. On one side, we have Bitcoin or BTC. It's the original, widely viewed as digital gold. Its defining feature is a hard-capped, limited supply of exactly 21 million coins, which creates absolute scarcity and real potential as a long-term store of value. On the flip side, we have Ether, or ETH, which is the native coin of the Ethereum network. Ethereum is fundamentally different. It was built to be highly programmable. It allows developers to write code, known as smart contracts, directly onto the blockchain to create decentralized applications, or DApps. So if you think of Bitcoin as digital gold, Ethereum is essentially a decentralized global computer.
Basically, any cryptocurrency that isn't Bitcoin is commonly called an altcoin. But they aren't all just digital money. They serve very distinct purposes. Let's look at this table. Utility tokens, like ETH or XRP, serve specific functions right on their native blockchains. Transactional coins, like Bitcoin, are designed primarily as a payment method. Platform tokens, like Solana, are built to support massive ecosystems of decentralized applications with super high speed. And governance tokens, like Uniswap, actually represent voting rights, allowing the holders to dictate the future rules of that specific blockchain protocol. Understanding these different types is absolutely crucial to evaluating any project's real-world value. To evaluate the size and the dominance of any of these projects, there's actually a really simple formula you can use. Market capitalization equals the circulating supply of the coin multiplied by its current price. This quick math gives you the total market value of a cryptocurrency, allowing you to instantly rank whether a project is a globally established heavyweight or just a highly speculative, low-cap startup. As we wrap up this foundational module today, I want to leave you with this defining quote from our source material. Cryptocurrencies represent a new, decentralized paradigm for money. Honestly, despite the immense volatility, the technical hurdles, and the ongoing regulatory challenges, the core intent behind this technology remains completely revolutionary. It is an ongoing, fascinating attempt to mathematically enforce trust and security without ever having to rely on human intermediaries.
So, with the mechanics and the realities now firmly in your grasp, the real question is, how might decentralized finance fit into your future? Are you going to be an active participant or maybe a skeptic watching from the sidelines? Take some time to digest what we've covered today, do your own research, and I will see you right back here for Module 2.